Welcome to Strategy Saturday. I'm Charles Carillo, and today we're going to be discussing what is the difference between physical and economic vacancy. When you're purchasing a commercial property, there will be a line item for vacancy, and understanding the type of vacancy will assist you in determining the true performance of the property. Physical vacancy refers to the actual number of units that are physically vacant. If your property has 50 units and 5 are physically vacant, your physical vacancy rate is 10%. Economic vacancy refers to the difference between a property's gross potential rent and the actual rent received. Physical vacancy is the percentage of units that are unoccupied and is determined on an annual basis. If a 50-unit property has 5 vacancies that are vacant for 12 months each, the physical vacancy rate is 10%. If those 5 vacancies are only physically vacant for 6 months of the year, the physical vacancy rate is 5%. It doesn't take into consideration if anybody in those occupied units is paying rent or not. Traditionally, when you hear vacancy rate, most investors and brokers are referring to its physical vacancy. Economic vacancy is a little bit more involved, but I feel is a better measurement of the strength of the tenants and the strength of the asset. It is defined as the difference between a property's gross potential rent and the actual rent collected. In other words, how much of the property is actually collecting income. Now, the benefit of economic vacancy is that it incorporates a number of factors into the vacancy rate beyond whether the units are occupied or not. It combines occupied units that are not paying rent, tenants that are not paying rent, units that are occupied by management, such as model units, units that are down for repairs and make ready, along with the result of rental concessions. For example, a property has a gross potential rent of $1,000 per month and there are 50 units. That is a gross potential rent of $600,000 per year. However, there are 5 vacant units, 1 model unit, and 2 units being made ready, and 3 units with rent concessions of 1 month free rent. So in this scenario, we have 8 units that are vacant, and then there are 3 units with 1 month of free rent. So what we would do is we would take the 8 units, multiply them by the monthly rent of $1,000 times 12 months, because it's done by a year, that's $96,000. Then we would just add on the 3 units with 1 month of free rent, which is another $3,000. So really you have an economic vacancy of $99,000 from all these vacant units and the rental concessions. That turns into be a 16.5% economic vacancy. Now, someone comes into this, another buyer wants to buy this property and they're looking at it. They're thinking in the back of their head, and how you should be thinking is, well, by renting 4 of the vacant units, I'd be able to lower the economic vacancy to $48,000 or 8%. Better yet, maybe you would rent even more units and lower that even more. But it shows the power that it is in turning units quickly and renting to good tenants. Now, the economic vacancy provides a more realistic overview of the property, the total units that are vacant, and the overall impact that has on actual rental income. The vacancy rate is important because with commercial properties, a high vacancy rate at the time of purchase is one of the most obvious ways that investors can add value. It is also one of the most solid value add plans since most of the property is already paying those rental amounts. There is a solid proof of concept. Yes, we would love to get $1,100 per month for those rents, but we know that we can get $1,000 per month for those rents, and we will work out our proforma on that. If we get the $1,100, that's all the best, but we know for sure we can get that $1,000 a month because we have the rest of the complex that's already paying that. So thank you so much for listening. Please remember to rate, review, subscribe. Submit comments and potential show topics at globalinvestorspodcast.com. Look forward to 2 more episodes next week. See you then.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.